Hi, welcome back. In this session, I'd like to talk about the first 6 months of 2022. It's been a tough 6 months. Bond rates are rising, stock prices are down, crypto's imploding, and even true believers are wondering whether this is the big correction that people have been looking towards for much of the last decade. Now, it's easy to call this a correction and move on, saying it's been long overdue, but I do think it makes sense to look at what's happening under the corrections, because that might provide us an answer to how much more of the correction is left and how quickly markets can come back. To understand what's been going on in markets this year, I'd like to introduce the notion of what I call risk capital. It's just a fancy word, but I'm talking about capital invested in the riskiest investments. You take every single asset class. There are safe investments and there are risky investments. And we can go down asset class by asset class. In bonds, the safest investments might be guaranteed, almost risk-free. Bonds issued by default-free entities. And at the other end of the extreme, if you're still looking at fixed income, the riskiest investment might be triple C, double C, high-yield bonds. In public equity, there are probably no guaranteed investments, but you can have very low-risk equities. Money-making companies that pay big dividends, perhaps utilities, phone companies, at least the old phone companies. And at the other end of the spectrum, you have money-losing, high-growth companies that are incredibly risky. In the private equity space, you can be a private equity investor in mature money-making businesses with stable cash flows and low debt. The safest. The other end of the extreme, you can be a venture capitalist investing in angel financing, seed companies or pre-seed companies, very young companies. In real estate, the riskiest investments are probably investments which are speculative real estate with very high debt. And at the other end of the extreme, the safety side, you have REITs and MLPs and with very high dividend yields, perhaps that can sustain those yields. Even in the collectible space, there's a spectrum of risk. You have precious metals, which have been around a long time, not very exciting, but they tend to hold their value and don't have huge swings. You're not going to see gold go to zero or 500,000. In the middle, you can put in some art and trophy asset collectibles, which have sustained demand, a following in demand. And collectibles, the riskiest collectibles tend to be ones without a history. We are hoping that they will be the next big thing, but you don't know. You probably put much of crypto in there right now. Now, investors are needed for both ends of the spectrum. Investors who invest in the riskiest assets in each of these classes, let's call them risk capital. And investors at the other end of the spectrum, let's call it safety capital. Now, if you want to use the old dividing line of markets of fear and greed, greed drives you towards risk capital, fear drives you towards safety capital. Now, to take a closer look at risk capital, let's start by dispensing with the delusion that some people provide risk capital and others don't, because almost every investor has some portion of their money that they might be willing to set aside into risk capital. How much you set aside will vary across investors. For some, that portion might be the amount of money they're willing to lose and feel no pain in terms of loss of lifestyle. For some, it can be the portion of their money that has the longest time horizon, on the assumption that time will take care of the risk. And for some, it might be gambling money, money that they view as money they invest, and they do it purely because it provides a huge potential upside. So within every investor's portfolio, there's a mix of safety capital and risk capital, and that mix can vary across investors depending on risk aversion. There's also variation across time. The amount that investors collectively are willing to invest in risk capital can be high in some periods and low in others, and I can think of at least two forces that might explain the variation. The first is momentum. When markets are doing well, when asset prices are going up, more money goes into risk capital simply because everybody has that excess capital that they can invest. Conversely, if markets start to drop off, you're going to see less money in risk capital. So almost by definition, risk capital is going to be higher when momentum is strongest and lower when momentum is weakest. The other, of course, is investors, to be willing to take risk, have to feel secure about their economic standing. So if you're in a healthy economy where there is stability in the economy, you're less likely to see people put money into safety capital alone, and more money will flow into risk capital. There are at least two macro factors that I think can also explain why risk capital is higher in some periods than others. If you think about it, if you decide not to put your money in risk capital and put into safety capital, there is a price you pay. There's a cost to being a safe investor. And that cost is that you are, that you have to put your money in safe investments that provide a guaranteed rate, but that rate might be much lower than what you can make on risky assets. So in an indirect way, what the level of interest rates is can affect how much risk capital there is. If the level of interest rates is very low, zero or negative, as it's been for some of the last 10 years, then if you don't take risk, the price you pay for not taking risk becomes much greater because your money is now invested in investments that make close to zero. And this is often what people talk about when they talk about the Fed inducing people to take more risk, or central banks inducing people to take more risk by keeping rates low. Now, you know that I don't think the central banks have complete control over rates, but it's true that they've tried to keep rates low, and that in a sense can push people into risk capital. The second macro factor is inflation, something I've written and talked about this year more than I have in previous years. And as inflation goes up, I've mentioned it also becomes more uncertain. There's more volatility. Now, why does that matter? As uncertainty about inflation increases, then the desire to take risk is going to drop off because you're worried about what can happen, but you're also more likely to move across asset classes. As I mentioned earlier, when inflation starts to rise and unexpected inflation is positive, financial assets are negatively affected. So you might see investors shifting away from financial assets. But even within each asset class, you can argue that the higher interest rates that come with higher inflation can result in less risk taking. Now, this, of course, has consequences. What am I talking when I mean this? The ebbs and flows of risk capital. Every risky asset class, what you will see in that asset class is risk premiums, a price of risk in that market. You could argue that the price of risk in every market is driven by the presence of risk capital. When risk capital is plentiful, the price of risk or risk premiums decrease. When risk capital becomes scarcer, the price of risk goes up. In the bond and the loan markets, the price of risk takes the form of a default spread, what you charge over the risk-free rate. And as risk capital becomes less accessible, less available, default spreads are going to widen. And they're going to widen more for the riskiest bonds, the lowest rated bonds, and the riskiest loans. In the equity market, the price of risk is the equity risk premium, and that too will tend to go up when risk capital becomes scarcer. There's a second consequence. As some of you know, I make a big deal about the difference between the words price and value. Value, I've argued, is a function of cash flows, growth, and risk. Price is a function of demand and supply, and behavioral forces, mood, momentum, liquidity plays a much greater role in pricing. Now, I've also argued that the value process and the pricing process can yield different numbers, and people who play the value game are investors. They buy something for less than value in the hope that the price moves towards value. People who play the pricing game, I've argued, are traders. Now, this doesn't always have to be true, but it tends to be true that if you're a safety capital player, a person who believes in safety capital, your sweet spot is going to be more towards value. Why? Because you're buying cash flows and you're buying dependability and safety. If your preferred habitat is risk capital, you're far more likely to be playing the pricing game. I'm not suggesting that people in the risk capital space don't care about value, but I'm saying that they're more likely to be driven to play trading games. So as a consequence, you should expect to see, if risk capital becomes plentiful, that the pricing game dominates and the value game falls to the wayside. Finally, another construct I've used in a lot of my sessions and posts is a corporate life cycle. That companies are born, startups, they're toddlers, young companies, and they become mature, middle-aged companies, and they get old, and then they die. Now you're saying, what's that got to do with risk capital? Early in a corporate life cycle, companies will tend to have negative cash flows, cash burn. It's not a problem, it's a feature. It happens because these companies don't make much money and they need to reinvest a lot for the future. As they mature, they have positive cash flows, they're self-funding. Now, here's where risk capital comes into play. If you have negative cash flows, you are dependent on risk capital to cover those negative cash flows. So when risk capital is plentiful, you're likely to see that young companies prosper. When risk capital becomes scarcer, you're going to see that young companies are hurt more. So in a sense, risk capital plays out in risk premiums, risk capital's ebbs and flows play out in the price versus value game. They play out in the corporate life cycle. With that background in risk capital, let's talk a little bit about how the availability and access to risk capital has varied over time. And to get a sense of this historical perspective, I'd like to look at three proxies for risk capital. The first is funds invested by venture capitalists, who after all, whether they invest in seed financing or very young companies, are investing in risk capital. The second is, if you look at the exit for venture capitalists, often through initial public offerings, and it's a well-established fact that IPOs tend to be higher. There are more IPOs when risk capital is accessible. So you can look at the trend lines in IPOs. The third is bond issuances by the riskiest companies. And here you might use as a proxy for risk the ratings of a company. Now, in good times, investment grade companies and companies without investment grades can issue bonds. But in bad times, when risk capital is scarce, companies that are not highly rated might have a much more difficult time issuing bonds. So let's start with venture capitalists as our first measure of risk capital. This is a very long-term graph of venture capital, so going back to 1995. You can see the ebbs and flows in the columns, the red columns, and you can see how venture capital soared in the 1990s with the dot-com boom. And in 2000, venture capital exceeded, the amount of capital, the venture capital that came into venture capital exceeded 100 billion for the first time in history. That glory year didn't last very long, because then you had the dot-com bust, and you can see how very quickly venture capital fell off. Built up again, then you have the 2008 market crisis. You can see venture capital take another drop, dropping almost 50% in 2009. Took almost 5 years to come back from the 2008 crisis. And then you look at the last decade, you can see it's been a very good decade for venture capital. In fact, in 2021, venture capital hit an all-time high, raising 131.18 billion in 2021. The other data that I've graphed in here is the number of companies. If you think about it, venture capitalists invest in companies because they want to exit them. They don't want to hold these companies forever. And the two ways they exit are through IPOs or by letting companies be acquired by other companies. The black line graphs the number of companies where the value at exit was greater than $1 billion, IPOs or M&A. So-called unicorns. I've used the 1 billion as a very simple proxy for how well a venture capital has been doing. And you can see how that number has soared in the last decade. In fact, until 2010, there were very few firms that when the venture capitalists exited gave them $1 billion plus. Since 2010, that number has increased every year. And in 2021, there were 43 companies that meant venture capitalists either took it through an IPO or had acquired for more than $1 billion. It's been a good decade for venture capitalists, but you can see in its history that venture capitalists has had ups and downs. Let's take a look at IPOs. Again, the way people describe IPO markets are either hot or cold. In hot IPO markets, you have lots of IPOs. Again, you can see the buildup of IPOs in the 1990s. So as venture capital's money is flowing in, IPOs are also soaring. And as with venture capital, see the drop off after 2000. Then you come to 2008, another drop off, and then you see again for much of the last decade, the last 7-8 years, that IPOs are back and soaring. In fact, again, we hit an all-time high in 2021, both in terms of number of IPOs, mostly in terms of dollar value raised from IPOs, but in terms of number of IPOs, again, we're approaching higher numbers, perhaps not as high as in the 1990s, by higher numbers. So as with venture capital, you have IPOs going through hot and cold markets. Finally, let's look at corporate bond issuances by both investment grade and high yield bond issuers. In this graph, the green portion of the green part of the column gives you the investment grade bond issues. The red portion of the column gives you the high yield bond issuances. And the black line specifies the percentage of the bond issuances from high yield bond issuers. Let's go back again to 2000. By now, you've seen what that year did to risk capital in the form of VC and IPOs. You see the percentage of bond issuances from high yield bonds drops off in 2000. Then again in 2000, after 2000, in the 2008 crisis, and again there was a brief drop off in 2018 as well, but not as steep a drop off. But 2021. We're approaching all-time highs. About 25% of bond issuances came from high-yield bond issuers. So what does that tell you? If you look at VCs, IPOs, high-yield bond issuers, you see the ebbs and flows, and it's not coincidence that it seems to be happening around the same period. The 2000 dot-com bust, the 2008 market crisis, and the question is, what's coming next? So let's bring the numbers up, update through 2022. It's been only 6 months, but if you look through the 2020 through 2022 time period, so 2.5 years, feels like it's been almost a decade, doesn't it? But that's because we started 2020 with a pandemic that changed our lives, and in 2022 we've seen inflation come back at levels we haven't seen in decades. So maybe looking at these last 30 months will give us a sense of both what risk capital is doing now and what it might do in the future. So let's start with venture capital in the most recent quarters. So if you look at the most recent quarters and you look at the first quarter of 2020, that was when COVID hit and you had the shock, you can see venture capital dropped off, in every level of venture capital. But then you see venture capital come back stronger than ever before through the rest of 2020. In fact, by the end of 2020, venture capital is running ahead of where it was pre-crisis, and 2021 has been an astonishing year. Another common thing you're noticing, right? 2021 has been a big year for risk capital, a really good year, on every dimension of risk capital. We have the first quarter of 2022, and it's a drop-off, still high by historical standards. But the first quarter ended on March 31st of 2022. We still don't have the second quarter numbers, but I'd expect to see a significant drop-off in the second quarter. What about IPOs? Again, we had the brief drop-off in the first quarter of 2020, but then again it bounced back better than ever before. 2021, a big year for IPOs, but the first 2 quarters of 2022, you've seen a big drop-off in IPOs. Again, I'm not extrapolating yet, but clearly something is happening in 2022. If you look at high-yield bond issuances, again, you can see the first 2 quarters of 2022, the drop-off in bond issuances in the first 2 quarters. All in all, if you look across risk capital, it's clear that we're slowing down in 2020. It's not clear, 2 things are not clear: how much the slowdown will be and whether there will be a bounce back like 2020, or whether this is going to be more like the markets of 2008 and 2000. Now, as risk capital has become scarcer this year, and you can see from the graphs that it has become scarcer, there have been consequences. The equity risk premium has climbed this year. It started the year for the S&P 500 at 4.24%. This is the implied premium. And it's now up to 6.43% as of today, at the end of trading on June 30th, start of trading July 1st. The T-bond rate has doubled from 1.51 to 3.02%. If you add those 2 numbers up, you get at the start of the year that the expected return on stocks was 5.75%. Now that number is 9.45%. That's a pretty big jump in the expected return. It's not even pretty big. That's a really big jump for stocks, and no wonder equities are struggling. And I did take stocks and break them down into risk classes to see if risk capital is playing out differently across different risk classes. Remember, we talked about in the corporate life cycle how companies that are money losing, that need external capital, are most dependent on risk capital. So here's what I did. I broke companies down in 2 dimensions. One is profit margins, where I defined profit margins in terms of net profit divided by revenues, net margin, from lowest to highest. So the lowest net margin classes include almost entirely money losers. In fact, they spill over into the first 2 classes. And in terms of revenue growth, I broke companies down based on their compounded annual revenue growth over the 3 years coming into 2022 from lowest revenue growth to highest revenue growth. So if you look across the classes, and I'm not suggesting it's perfect, you can see that generally speaking, higher revenue growth companies are doing worse, have been hurt more this year than lower revenue growth companies. Companies with more negative margins have been hurt more than companies with better margins. So if you look at the worst affected sector, it's the companies with the highest growth and the lowest margins. I don't want to make a big mountain out of a molehill, but the way stocks are behaving is consistent with the withdrawal of risk capital from the market. So what now? I mean, clearly the fear factor is starting to override the growth factor now. And I think that it's not just stocks where you're going to see this. You're going to see markdowns coming to private companies, more so for the youngest companies that are dependent on seed capital. You probably haven't seen those markdowns yet because it's a lagged effect. By the time VCs mark them down, it might be 3-6 months after the actual markdown. But if you're a young company seeking capital, you're going to be looking at much tougher terms, perhaps down rounds in some cases, because risk capital seems to have withdrawn. So the big question we all face as we look towards the second half of the year is this pullback temporary like it was in 2020, or whether it's more long term? If it is temporary, then if it's temporary, then I think stocks will bounce back, and you should be in stocks significantly now. But it's the latter, we could be in for some pain, especially given how big a year 2021 was. Remember, we didn't get back to 2000 numbers, the numbers in venture capital and IPOs, for a decade or more. So if it's the latter, you might be in for an extended period where stocks collectively don't have to hurt. But subsets of companies, the youngest companies, money-losing companies, might see an extended period in the trenches. Now, which if you ask me which one I think is more likely, I don't have a crystal ball, but I'll give you my guess. If I had to guess, I think that this is in 2020. We're not going to see a quick pullback, return of risk capital. I think it's more likely to be longer term. How long term, I'm not sure yet. And here's what. Unlike a virus, which is what we were fighting last time, where you can hope for a vaccine that you think will solve everything. We didn't know better, but that's what we thought. No, inflation has no easy fix. I think that fighting inflation is going to take much longer and much more pain than the virus did in markets, at least. In addition, I think that this extended period where risk capital has been easily accessible and almost available to anybody who wants it has led people in the risk capital space to become lazy and sloppy. You see this play out in the riskiest investments in every single asset class, from the young money-losing companies all the way to cryptos. Now, markets have a way of cleaning up, and sometimes you might need a withdrawal, a pullback of risk capital for that cleaning up to happen. Now, whatever the case is, the investment strategies that worked so well over the last decade, you might need to revisit them and think about what to do differently, given that risk capital might be reverting back, if not to depressed levels, to a more normal level. Thank you very much for listening, and I hope you found the session useful.